have you ever wondered how much you should be paying to invest? How much you should be paying for advice? Let's talk about it. How's that sound for an intro?
Good.
Good.
I'm like, I don't know. I thought you were looking at how much. I'm like, I don't know.
Well, how much should you pay? If somebody said that's the thing, right? So to get into why I'm thinking about this now is which I'm really happy about, but there is a new disclosure coming towards the end of the year. Mm-hmm. So I'm extremely fee sensitive. Mm-hmm. We'll go over actually what my fees are so people can compare and stuff. But fees are a really important part of investing. Mm-hmm. Fees aren't the whole story. You need to be getting the value for it, right? So people often say like you get what you pay for, but there is a line, and in my industry that is very often not true.
Okay. You get what you pay for. It's not true? Yeah.
Yeah, you get what you pay for is not true.
Yeah.
Because just because something is more expensive, absolutely, especially if what they do is manage money, like I say that like so there's two parts of what I would do for clients. There's a financial planning piece, and then there's the money management piece. Mm-hmm. And then depending on lots of things, I might even be hiring a money manager to pick the individual stocks and stuff like that goes into a portfolio. So depending on what you're paying for, there's value assigned to parts of that chain. Mm-hmm. And overpaying for parts of that chain just costs more sometimes. Mm-hmm. So we'll kind of go through that. But part of the reason is because this is going to be the first year, so the end of 2026, that they will disclose on the statements not only the advice fee that you're paying, but the management expense included in that.
So they're going to break down what you're actually paying for?
The total amount. So before this point, you would only see the dealer fee almost. So what they're paying me and TCU and Aviso, all of that bundled in, right? Mm-hmm. You wouldn't see what you're paying for certain.
Oh, so they wouldn't see
other part of the. Does that make sense?
Oh, I was gonna say, does that mean they would see? This is what Trey gets. This is what TCU gets. This is what.
No, they don't see that. They just see this is what Aviso takes.
Okay.
And that money that Aviso takes pays Aviso, TCU, me.
But you're saying they're going to disclose the other
side. So there's two parts of the fee. There is that side.
Yep.
And then, which is like the servicing side, the client servicing side. Mm-hmm. And then there's the fee of whatever product we're using. Okay. Yep. And this is something that while I'm very very fee sensitive. It's a big part of the reason I make certain product decisions and things like that is to do with cost. I am a rarity. I'd say the majority probably aren't as open and pushy about fees, whether because they don't understand the impact on it or whatever it is. It's just not as talked about.
So you're saying in comparison to other advisors or planners, they don't care. Maybe that's the wrong thing to say, but they care less, or like
care. I think half of them just don't understand the impact.
Okay, so they're like, "Oh, it is what it is." You're paying 3.5%. I don't know if that's a normal number, but
right, and that's part of the issue is that you don't know what to benchmark it against. So that's why I was going to do this episode so that people have something maybe to benchmark it against, right?
Yeah.
But you're absolutely, yeah. Does that make sense?
Yeah, I think so.
Okay, good. Yep. So we will get into the two parts. So we'll talk about what you should or can be expected to pay on the product side. And then we'll talk about the advice side, right? The end part. So for the product side, it's not really a debate, but there are two main routes that you can go when it comes to investing. Do you know what those two routes are? We've spoken about it in previous episodes.
Passive or active?
Yeah. There you go.
4 claps. Now we can time
it. So, yes. So which one do you think would be more expensive?
Active.
Why?
Because you're paying somebody to work specifically for you kind of thing, like on your portfolio and like watch and stock picking and stuff? Is that what active
Kind
is?
of, yeah. So you're paying for somebody to go and analyze each individual security. You're paying for a team of analysts. It's going to be some of the brightest minds go into that type of field, right? Like trying to,
Yeah.
for various reasons, but some of them often it's to try to beat the market. Okay.
Yeah.
Which means there's cost involved in doing so.
Yeah.
So I brought up a bunch of balanced funds.
Okay.
So a balanced fund is basically like 60% stocks, 40% fixed income. So it's like the default option. It's
that's the pension fund option.
Yeah, typically, right? Like especially the old school pension funds where so in my industry, we measure risk in volatility. So how much volatility something experiences.
Yeah.
And there was a sharp ratio, how to describe this. There was a formula that was created to determine how much return per unit of volatility that you would get.
Okay, so
Okay.
I think that makes sense.
To try to find the most efficient way to invest. But my issue, and that has been the way to do it. It's the balanced fund for long periods of time.
Yeah.
My issue is that volatility isn't
Dictate
the
results.
only risk. Well, it's just not the only risk that you have.
Yeah.
And if you're optimizing a portfolio based on volatility, is that all right?
That is uncanny. She never
Okay.
wakes up this. That's probably a bad dream. Do you want to do it? Or do you
I can.
Yeah. She usually wants you if it's a bad one.
You can finish this conversation.
Okay, so basically volatility. He's coming back. So soon. That was very, very fast. She went right back down. She probably didn't actually wake up. There's some secret hidden messages in there for.
Oh no. I'm not gonna cut anything out. I'm back.
You
never left.
have to cut that out. Just FYI.
Hello, this is Editing Trey here. If you want to hear my wife's ramblings, I put it at the end of the episode. Okay. She went down pretty quick. That's awesome. What was I saying?
Volatility risk is not the only is not the
It's
only
not the only risk.
is not the only risk in your industry.
Yes, but it is the one that they were using to come up with this. Anyway, balanced fund was the answer to that.
Right.
So what I have on my screen is just comparing a bunch of balanced funds. So as we spoke about, some typical discussion about when it comes to types of management is passive versus active, and as I've touched on before, there's some kind of that fit in the middle of that, various ranges. Anyway, so I have four active strategies here, all at very different price points. And I want to be very clear here. Picking any of these is fine. Like, as in, I wouldn't say it's fine from a, like, do I think it's a good idea to pick any of them? No. But I'm saying that somebody...
It's better than doing nothing kind of thing?
Yeah, but no, that is true. But no, I'm saying that there isn't a person out there that can truly tell you which one of these managers is going to outperform. They're all very large funds, very high quality managers.
Oh, I see what you're saying. Yeah.
Would I say that some of them are better teams than others, etc.? Yeah, by a small amount. But does that then translate to better performance? No. And you're going to see that, right? But these are different ones. So this one charges 1.1%. That's the management expense ratio. So what it costs. So 1.1%. So this is like the taxes, but it's also part of this is compensation to the management team. Okay. So that's 1.1%. This would be expensive, right? So remember, this is not the all-in cost. This is just for the product itself. Okay.
So it's like you're paying for the product, then you're paying for like the other part of the fee, which is like
how you get the product, however you access the product. You have to still pay for that part.
Okay. So what about, sorry, I'm probably jumping around like I always do. What about people who just go to like Wealth Simple or something?
So it depends. So Wealth Simple have two sides of it, right? Same for Visa. There's two sides. There's the brokerage, like Q Trade, which is you go and buy it yourself.
Yeah.
And then there is the robo-advisor. So a robot puts together the portfolio.
Yeah.
So again, this would be, let's say you was using a robo-advisor because that was what was putting together the portfolio and they were using these products. You'd pay for the robo-advisor fee.
Yeah.
That's how you're accessing it. And you would pay for the product fee.
Yeah.
Same for if you went through an advisor, you would be paying the advisor fee and then you'd also be paying the product fee.
But what about if they do it themselves?
So they're self-directed, then you'd just be paying the product fee and then whatever the fee was to buy or to use the platform.
Okay.
Right?
Yeah.
So you wouldn't have to be paying
like, even though some of those places are like, it's free, it's probably not. Is it free?
Depends.
Okay.
It really depends. That's a huge discussion that we're not going to get into today.
Sorry. I'm like,
because some of them will
I just know people
sell money flows and stuff, but it doesn't matter. It's for the sake of this, just think of it as two separate fees. So this is just the product fee that we're comparing.
Okay.
So this fund is 1.1%. That would be, I would consider that expensive.
Okay.
Okay. This one is RBC's version. This is 0.94%. And you're now getting into the typical range. Okay. So
average,
right? This is another fund. This one is 1%, right? This is a fund that I sometimes use. And this is 0.5%. Okay. All four of these are active management. Okay.
Oh, okay.
So they're all actively managed. But can you see there's quite a range? I know we're talking about like 1% seems so small, but keep in mind that. So this one, the one that I sometimes use is 0.5.
It's half price.
It's half the price of this fund.
Yeah.
Okay. Now, here's the interesting part. Now let's go look at the returns. Okay. Let's say they all started at the same time. So that would be 2018. So since 2018, what would the performance have been? Okay. So for this one here, that is 1.1%. The performance is 6.24%.
Is that what people average?
That's what, if you'd have put it in at the like in
2018,
that's what you would have, an investor would have gotten back.
Okay.
Over that time period. Okay.
In total.
Yeah. Like averaged each year.
Oh, average.
So an average of 6.24%. Yeah.
Okay.
So they put your money in.
Yeah.
That money has grown 6.24% annually until now.
I feel like the annually thing is like throwing me off a little bit.
Yeah.
But okay.
Does that make sense?
I think so, yeah.
Okay. So then we compare that to a cheaper product. So let's look at this McKinsey one. This is 1% as opposed to 1.1%.
Yeah.
This product has averaged 6.92%. So slightly higher, right?
Yeah.
What
was it? 6 point? You just said
6.9 versus 6. So 0.7% higher on average
for a cheaper product.
Okay.
Okay.
Then let's compare it to the RBC one. So the RBC one was 0.94%. That's now returned 7.9%. So an almost 1% more. And it's so far the cheapest of these three products that you're talking about.
Yeah.
Okay.
I'm going to jump the gun again here. Do they include the fee?
Yes, this is after the fee and everything.
Okay.
Yeah.
So it's like the fee
This is what the client got.
Yeah. So maybe that's impacting it as well.
Yeah, very much so. And then we look at the Vanguard fund, which is the cheapest one out of the active managers at 0.54%. And their common history return is 8.99%. Right? So
Crazy.
by far the best, but it is the cheapest. So it's the best, but it's also the cheapest.
Yeah.
What you'll notice if I lined up hundreds of these, you'll see a pattern that the cheaper the funds, the better the performance. Because, and I can't stress this enough, people are playing in the same sandbox.
Yeah.
Nobody has this secret magic
sandbox.
Yeah, basically. Nobody has this secret. And even people talk about the investing greats. You go back to Warren Buffett and you're like, incredible investor, right? When you look at his returns post I forgot the name of it, but post when public markets, like the information that was shared for public companies, it
went live kind of thing.
Yeah, like it increased in quality, like the standard increased of how much public companies have to share with their investors. When that changed, so that was in the 90s-ish, Warren Buffett's returns compared to the market dropped off a cliff. Because information leveled the playing field.
Yeah.
And you see that consistently, that yes, an active manager in private markets where the information isn't as readily available, having a team of analysts and all that fun stuff is an advantage. But when you get into public markets, that advantage significantly drops.
Yeah.
So while you do have the outliers that happen to outperform the market significantly, that's why I say why for most people, it isn't a good choice to pay more for active management when the likelihood is that they're going to underperform. Okay.
Yeah.
So that was roughly the cost. So basically on the high end, if you're paying any more than 1% for a product that's actively managed, you are significantly overpaying.
You're overpaying and you're probably you're not performing as well.
In these examples, if somebody's willing to find me one that has, let me see it. Because it's very rare, right? You might get the odd one, but the fact is you have to be able to pick these different management teams or whatever before the outperformance happens.
Yeah.
If you find a way to do it successfully, let me know. We can make a lot of money.
They're like, I don't want to let you know.
So CBP just released their numbers and they underperformed their benchmarks again for the millionth time in a row. Just proving it is very difficult to do. Most people would be much, much better off just not bothering. Okay. And then, so that's what you should be thinking about for in that range. So anything, I would say anything above 1%, way too expensive. You should be trying to aim for, if you're wanting to go the active manager route, you can get options as cheap as 0.5%.
Yeah.
So you should be probably realistically looking in that.
I want to say like 0.7 is like a good.
0.7, 0.8 range is likely what you'd be paying for.
Yeah.
For an active manager. Okay. Now let's compare that to a passive strategy, right? Okay. So I have two here. I have, again, dimensional. I use them a lot. And then just iShares. So it's kind of like they just use basic indexes to put their products together. So again, these are both balance funds. Now, what are the price of these ones?
Sorry, can you angle it a bit? It's just the glare is so bad for me. 0.2% for iShares, 0.28% for
dimensional.
So
significantly cheaper. So compared to the NBC, the National Bank one, which is 1.1%.
Crazy. 0.2.
0.2. So 5 times cheaper.
Yeah.
Okay. What do you suspect we're going to see from performance?
Great performance. Because the fee
in
is
comparison.
I think it's going to be awesome.
Yeah. Awesome. So you look at the Meritage one did 6.24%.
Yeah.
The passive one, purely passive one, did 8.4%. Right. So yes, the Vanguard one, the cheap one, happened to outperform in this time frame, but you can't expect that forever.
Yeah.
The performance did 8.5%, right? Over the same time frame.
Yeah.
So, and that's the cheapest one.
Yeah.
So tell me again why, why, but like when I said at the beginning that sometimes you don't get what you pay for.
Yeah. You know what's funny? This is like a marketing trick as well. It's making me think of a part of a book I read. Again, do I remember the name of the book? No. Sorry, everyone. But it was talking about, there was an example it talked about of a woman who owned a jewelry store in Arizona. So they were selling turquoise, if you know anything about the States. And, like some of the indigenous tribes that were there, turquoise is a big thing. Anyways, so some of the handmade jewelry that was there, she was trying to push it out of the store, so she marked it down half price. Nothing happened. So then she wrote a sticky note to her employee saying, can you mark this down to like 75% off? Because they want to get it out. And he misread the note. I don't exactly remember what it, like the exact numbers of how he got it messed up, but he made it a lot more expensive. Basically, like upped it by $70 or something like that. Whatever. So anyways, it was a lot more expensive than it had originally been. And then even more so than when they marked it down, and they sold it out immediately. Like within a week, it was all gone. And she was just mind blown. Like, how did this happen? You know, like how did I make more money on these things that I was trying to get rid of for so long, tried to mark it down, didn't entice people, but making it more expensive enticed people. And I think it's a mentality thing. That was what the book was partly about, was basically we have these almost like automatic tapes that play in our head that just tell us, it's, again, we've talked about this, having the easy answer so your brain doesn't have to actually think. Oh, more money. I spend more
better quality.
More money equals better quality, better value. So I don't want to think about it. You know what I mean? So people look at the jewelry store and they're like, wow, these pieces are so much more expensive than the rest of them. They're going to be really good, which isn't true. But it is the story that we tell ourselves or whatever. But that's what it makes me think of, and why people probably still pick those, because they think they're doing something. You know, it's like probably just a mind game.
Yeah, I think there's a few reasons that people pick them. One of them is ignorance.
Yeah, for sure.
That's a major problem
but that's kind of similar,
Canada,
right? Like
ignorance.
if you walk into a jewelry store and don't know anything about
Yeah.
it, it's ignorance, right? Like
Absolutely. You don't know what you're comparing it to, which hopefully this episode will help. That you
you
have an
have a
idea
bunch.
what you should be comparing, what you expect to be paying. I also think that, well, I know that the wealthier you are, the more that you think there's something special out there for you. That happens very often, that, you know, I have $5 million. I should be getting more than the average person. And they do things to try to get more than the average person.
Is that like an ego thing, do you think? Because you just said, like,
yeah.
It's like, I have this much money, I should
I think
be above.
Yeah, I think people expect to, the more you have, to just have more access. And you do get more access, right? Like you do.
Yeah.
You have access to different types of investments, and you're a accredited investor, so kind of you can invest in whatever you like.
Yeah.
Doesn't mean that you should. And for most people, the vast majority of people, and you hear stories about it all the time, but still people don't just do what they hear to be true. But you hear stories of
it to be complicated.
Yeah, but you hear stories where these big investment companies will go and like invest all this money and buy companies, and they make another company, it ends up being really big or whatever, and then you look at the return and you're just like, if they'd have just put their original payout into the markets and just left it for 20 years, they'd be ahead. Right? Donald Trump's a big example of that, where it's like, if he'd have just taken the money his dad gave him and put it into the markets, he'd be richer than he is today. Just bought an index fund.
But again, people like that, that's another, like a whole nother topic. But I find people like that, it's too boring.
Yeah, absolutely.
Like they need that, like, chase, the risk, the, like, they want to work. I always say that about you. You're like, oh, when I retire, I'm like, when are you retiring? It's just never gonna happen. There's a
difference between having to work for money and doing things because you enjoy it and you're interested in a project and you.
But I think that's what people do. It's like at
Yeah,
some
I think
point,
you're
how
right.
much money do you really need? It's like
So
if you're
you do cool
bored,
things.
you like look at
totally
Elon
agree.
Musk.
Yeah, pretty
He's
much.
bored.
He wants to go to Mars instead.
He's not bored anymore. Look at what he's doing.
Yeah, absolutely. But yeah, so as I said, so what you're looking for is so that there is, what's the best way to say this?
Is this like
Passive,
a recap?
Yeah. So
Okay.
passive investments or things like that are going to be significantly cheaper.
Yeah. Because you don't have a team of analysts like looking at everything.
Not
all
in the
time.
same way. Yeah, exactly. Like dimensional is like factor investing, right? So it's a little bit different. But when you look at when you comparing like the 10-year return on it, it's, the iShares is at 7.95 and DFA is at 7.97, right? Like it's going to be very similar, but what you would expect to see is that over like an entire market cycle, long time, you would expect to see certain factors outperform the basic index, but it doesn't mean you will see it every single year or anything like that. And you are talking about a sustained long-term investment time frame, and then you'd expect to see the outperformance. Again, all things being equal, the more expensive something is, likely the less return that you would get.
Yeah.
Right.
And it's like, what are
Especially-
you paying for at that point? That's the real
and that's
question.
the thing. That's really the question is when it comes to these types of investments, what are you paying for?
Yeah.
And once you determine that, you can determine whether the risk is worth it. Because if you are paying for outperformance, you're unlikely to get it, right?
Yeah.
And even companies that have outperformed doesn't mean it's going to continue to happen, right? You never know. There's been plenty of fund companies out there that have performed exceptionally well over short periods of time. Everybody piles on and dumps a bunch of money in there, and then they go to underperform for the next 10 years. Lots of them out there, right? Win fund awards, be the best fund in Canada, and then suddenly,
Falls
nothing,
off the deep end.
right?
Yeah.
Happens all the time. So, yeah. Okay, so that's on the product side of things.
Yeah.
Okay. Now on the advice side of things. So first off, there are three, I would say, but two main types of business models in my industry, but there's three really. So
I know kind of what you're going for.
Okay, what are they?
I want to say like a client. I don't know exactly the right words probably, but a client that you get paid by the markets basically. Like they're your client, they go through you, you get paid by how well the markets are doing because you're investing for them. Is that right?
Kind of.
Maybe I shouldn't be
guess there's
saying this.
four
You're
ways.
like, I'm gonna have to cut this out. Maybe I shouldn't answer. I was just thinking you're probably talking about the hourly rate as well as like a possibility.
So you can do, there's like hourly or project based, you can work with planners.
Yeah. So it's like, hey, my great aunt from PEI died and I got a huge inheritance and I don't know what to do with it. Like that would be a project based maybe if someone was like, it could be.
Depending on, depends on lots of things, but yes, absolutely. That could, there's anything that is planning orientated, it could be a planning hourly case, depending on lots of different things. But so there's the hourly planning. There is a percentage of assets. So we call that like assets under management. So you charge a percentage of the money that you manage. And then there is commission.
Okay, the assets under management was what I was thinking. Could you tell? And I'm
Yeah,
like,
kind of.
I know, like, how many times have you said those words to me? And like, just mine went blank. But
Yeah. So what do you think commission is?
Oh, I know what this is. I think. No,
Let us know.
I'm not going to because I need to be careful.
Why? No, it's fine.
You might have to cut it out or something.
Fine, whatever.
Possibly. Okay. So when you work at let's say you work at a bank, how do I explain this diplomatically?
No, it's fine. Just go for it.
Okay. So there's your dealer.
Yeah.
There's the company you work for, and then there's you.
Yeah.
So there's 3 parties involved in this particular relationship, I guess. So, and then there's like the products, right? So sometimes the product people have a deal with the bank or the dealer, and they want you to sell that product because they make more off of it if you sell it, I think. Is that right?
That happens, but that's not what commission is.
Okay.
So a commission is where
I was thinking you would make more if that product gets sold. No?
yeah,
So
but
it's like a
that's not
commission.
necessarily a commission thing.
Oh, okay.
So a commission is where the compensation for whatever it is derived by the product itself. So, for example, we looked at funds without any commission attached to it.
Okay.
But there are the same funds that you could buy. Because I have the RBC one up right in front of me, I'm going to use that one. So the same fund, but with a commission attached to it. In my industry, it's called an A series. This one, the cost for this one is 1.94.
Wait.
Because so before it was at 0.9-ish.
Mm-hmm.
Now it's 1.9.
Why?
Because that 1% is the commission.
Commission to who?
The dealer. So if it was me buying this fund, it would be 1% is sent to Aviso, and Aviso takes their cut. They then give it to TCU. TCU then takes their cut. Then
This is really complicated.
that's a commission. So it's embedded inside of the product itself. And
Okay.
until like 3 or 4 years ago, this was never, it was talked about, like you had to talk about it with the person, but it was never disclosed on any
Documents or
documents or anything like that. Like officially, like you didn't get a statement at the end of the year that showed you in dollars and cents exactly what was.
in a big red like bubble being like, here's how much you paid.
Yeah, you didn't get that. But now you do. Now you do get, they see the commission side of it,
Okay.
but they don't see the product side of it. And that's what's changing at the end of this year.
Who's they? Sorry, the client.
The client. Yeah.
Okay.
Does that make sense?
I feel like I'm struggling on this one.
Okay. Why are you struggling?
I don't know. Could be a multitude of reasons, like exhaustion. Okay, so who is paying the commission? I'm a client.
You're a client.
Yeah.
You're paying it because it's embedded into the price of the product.
But you are technically paying it at some point somewhere else? No?
What do you mean?
So if why would I not just pick the other product if it's cheaper? Why would I pick a commission?
Because that's what you get offered.
But isn't the other one the same?
Yeah.
Or... like, I don't get it.
But okay, well they might not offer you these because maybe if I finish up my 3 different ways, this will make more sense.
I feel like you're holding out something on me. Do you know you're holding something out on me?
No, but I think maybe the last one will help. So this is the way that I typically work, which is we charge a percentage of the assets that we manage, and then it's irrelevant what products you use. You're paying specifically for the advice. So think of it as with a commission, it's not the client paying you, it's the fund company paying you. Okay, when you're using a AUM fee, it's the client directly paying you.
I see. So that entices you to be more fee sensitive as well, correct? Because if you're being paid by the dealer, it's going through that route. So that would be...
If you're being paid by the fund company.
Who's the fund company again?
So let's say I buy the RBC product.
Which one?
This one with a...
The commission one?
With a commission in it.
Okay.
So there's this one without the commission, and then this one with the commission.
Wow. They look so obviously different.
It's just a number.
You just flip through the same page twice.
It's just a number. It's the only thing different that you'll see about these two is the number, basically. This is exactly the same fund.
Okay.
So this one costs 0.94. This one with a commission costs 1.94.
Yep.
Because that 1% is the commission.
Okay.
Okay, that's why their price is more.
Yep.
Okay. So if you're using a commissioned product, then it means that client pays RBC this amount, and that 1% is sent from RBC to the advisor's dealer.
Okay. So that 1%, so the client is paying for the fund.
Yeah.
That 0.94 goes to the fund place.
That 1.94.
No, because you said the 1% goes.
No, but it goes to the fund manager first.
Okay, and then the fund manager gives
Pays
the
you
1% to the bank. Like, let's say
the dealer. Yeah.
You said the
Don't
bankers.
don't use the bank because you're thinking of RBC. So use a Visa. Pretend I'm buying this.
Where does TCU fit in then?
Yeah, cool. Keep going down the line.
So I thought it was client
Yeah.
pays RBC fun fact.
Yeah.
RBC fun fact TCU.
No, a Visa.
Okay, a Viso and then a Viso TCU.
Yeah.
And then TCU tray.
Yeah.
So if client buys 0.94 fund, client to RBC fun fact,
Yeah.
RBC fun fact to a Viso.
No. There's no RBC. There's no RBC to a Visa.
Okay.
So you're only paying for the product.
But then how do you get paid?
So that's where the fee-based account comes in, where it's completely separate from the product. It doesn't matter. You're not paid through the product. It doesn't matter what product you use.
That's not part of it.
It's completely irrelevant to what the client is paying for. So, for example, let's say I was still charging 1%, right? Mm-hmm. Then in that case, 0.94% would go to RBC. Mm-hmm. 1% would then go to a Viso. A Visa then takes their car to TCU. TCU takes their car, and then I get.
So it would be the same but you say how much?
Yes. So it doesn't have to be 1%, right? So no matter how much I put into this fund, it's 1%. Okay. Mm-hmm. But let's say, so we'll get into like what I actually charge. So for example, I charge on the first $500,000, I charge 1.5%. Mm-hmm. So if you're a corporation owner, right? So this is like if your stuff is more complicated, I charge 1.2 if you're not. So if you have $300,000, I'm more expensive. You pay more than if you was to use the commissions.
Because it would be almost like you're doing a lot of work.
That's why I charge more.
Yeah.
Yeah. I charge what I believe is fair for the amount of work that I would be doing. Mm-hmm. It doesn't matter. I don't care what it would be if it was elsewhere. That's not what you're paying for. If you want somebody to take the commission, go walk into the RBC's branch and see what type of advice you get there.
Yikes. Ouch.
And this is very specifically for corporation owners, right? Like that's why I charge even more on the first $500,000 for corporation owners, because it takes me longer. It's more work. It's more complicated, more specialized skill set. It's harder.
Yeah.
So I charge more for it.
Yeah.
But what happens after that, right? Like it isn't, let's say I had $10 million and I walked into RBC's branch and I bought this RBC balanced portfolio for 1.94. Mm-hmm. You would be charged 1.94 on that full $10 million. Let's type in $10 million into my fee schedule. Mm-hmm. And on $10 million. Did you build
this calculator?
Yeah.
Of course you did. I'm like,
consistency.
Where did you get this?
I did the research on what I wanted to charge, and I figured out what I felt was fair, and then this is my fee schedule.
Yeah.
And then but for $10 million, I would be charging 0.4%.
Wow.
Right. So
that's a big difference.
A big difference.
People should work with you.
So on this, let's say I was still in the same product. Right? Still same everything, same product. The difference would be that if they had $10 million, they would be paying 1.3% versus.
Yeah.
And I would say a small factor that a lot of these fund companies will reduce their fee, mm-hmm. right? So instead of it being 0.94%, it'd be slightly less, like it goes down a little bit. Mm-hmm. But let's say it was 0.8, but it would be 0.8 on the product side and the commission side. So they're both. So I kind of ignore that for now. But yeah, so it makes a big difference. cost makes a big difference. But that is why I do not like commission products. I don't like it from a principal point of view, because if you're being paid by somebody else, who do you work for?
Yeah.
You're paid by the person that pays you. Well, there's only one person that like a financial planner should be working for.
The client.
And that should be the client. So the client should be the one that pays, not a fund company, not an investment firm, especially because they would do things like, which has been gotten rid of now, but they would do things like, if you locked the client in for 3 years, you get 3% of what they're investing up front, or you have 7% of what they're investing up front, or some places will pay like a 1.2% commission. Like all of this stuff, I hate it. Get rid of it all. You shouldn't be.
Because then it's like, again, it's like you're the middleman for the fund company to get more money for them.
Basically, you're working for them,
Yeah.
right? There should be zero incentive between you picking one thing over the other. It should not impact your compensation, what you should be charging your client at all, is my opinion, right? So that's why I always separate it out. So the only two ways that I really like to work is either a percentage of assets or like a project-based hourly predetermined amount for the work that I'm doing.
Yeah.
Okay?
Yeah.
So I'll go through my fees so you can kind of get an idea of what is what you could expect to pay. I'll give you an idea of whether it's expensive or not.
I just want to say really quick, I can completely understand if someone, wow, like I hate this. I'm sorry. I'm like, how much do I have to pay it? It's like, oh, let me just tell you 5,000 things about how you're paying. It's like, ugh,
well, that's why
I don't want to do all that. That's why people get lazy.
For sure. But you know what the crazy thing is? The amount of people that I've met with that they'll be interviewing advisors, right? And they will interview me eventually, and they will ask, because there's a list. Like if you Google what questions you should ask a financial planner or whatever before you consider hiring them, they could be very similar. You could ask about their experience, but fees are going to be a major one. And the amount of advisors out there that can't answer that question.
Like their fees?
Yeah. So they'll say like, how much are you going to charge me on like $2 million bucks?
And they're like,
and they'll say, oh, well, it'll be like competitive. Like for, it's like, well, can't you just give me a number? Like, oh, we'll talk about that later. Yeah, it's insane.
We'll talk about that later.
Like later on in the process of like onboarding or whatever that is, right? And it's just like, that's because they're picking their fee based on what they think they can get from you.
That's
insane.
Nasty.
Somebody walks into my office and says, I have $2 million. What are you going to charge me? I'm going to say, are you incorporated in any way? And they're going to say, yep. And I say, Kate, I'm ticking this box. Your fee is 0.91%. That's what I'm going to charge on $2 million.
That is...
Next question. Right? And the amount of people that don't, because it's just, I don't know. I don't.
But nobody makes a calculator. See, nobody's quite like Trey. How many of you guys are making calculators all by yourself? This was probably a Saturday night project for Trey.
I wanted it to be consistent, right? Like, I don't know.
Oh, for sure. This should be
standard.
Why did I'm not even? Maybe I shouldn't even go down that road. Like, why did you have to build this though?
Anyway, moving on. Yeah. So what I charge. So on under $500,000, if you're a corporation owner, it's 1.5%.
Yeah.
If you're not a corporation owner, it's 1.2%.
Yeah.
It's expensive. That is on the expensive side. Here's the truth, is that
I'm waiting.
This is the segment of the population that you either need somebody like me or you don't. If you don't pay for it. It is simple as that. Like, my skill set is very specific. If your life is very simple and you can afford to do it yourself and you can like do it yourself, right? Like it's a case of, I think most people should learn how to invest money on their own and literally go in, buy index funds, and they'll be great. What I focus on is all the other aspects. So honestly, if people were trying to do it as efficiently as possible, you would want to come to somebody like me for 2-3 years, learn as much as you can, and then go do it yourself, right? And then hire somebody hourly or something like that
Well, that's what I was going to say. Maybe even just hire like someone hourly to get them to look it over and stuff to make sure like, okay, you're kind of on the right track. If you were learning yourself, at least you have an expert opinion, because I think that's what would scare someone like me. It's like, oh, go learn by yourself.
And you don't know what you're missing and things like that. I would say there does come to a point where if you aren't willing to dive into it properly, the cost is worth it. Mm-hmm. Even if you're low complexity, right? Because the fact is you going in, picking 80% equity versus 70% equity. Well, if you working with an advisor can get you to 80%, you've made the fee multiple times over. That it wouldn't be like just in that small allocation change, right? So if you need the help, it's like with anything in life.
Well, yeah, I was just thinking about like taxes. So
if you can do your own taxes, do your own taxes. If you can fix your own car, fix your own car. If you can just represent yourself in court, guess what? It's a lot cheaper if you can represent yourself buying a home, definitely a lot cheaper than using a realtor, right? So just like anything, if you can do it yourself to a high quality, to a high level, do it yourself.
Questionable part again for those things, because I was thinking about, I remember like working in retail, first job, like I'm talking like teenager, and people were going to H&R Block to get their taxes done. I'm sure they were just raking in money because they're like, that's the easiest taxes ever. It's like these teenagers who have like the one slip.
And they charge them $150 or $200.
Like it's not like, it's not super expensive, but it's also like, again, the low complexity of it is not really, you could and should learn to do it yourself probably.
But the more important thing is that you do it, right?
Yeah.
So if I had to choose between somebody, even like these, I'm talking about like these high cost funds and stuff like that. If the choice is between you doing that or doing nothing, you do that.
Yeah.
Right? Like there are levels to optimization. If the choice is between doing nothing and doing something, then you
start
pick those
somewhere.
things. Start somewhere, right?
Yeah.
But basically. But I'm not the right person for. Like I can do it and I can do it very well, and that's the hard thing where. Once you get to a certain level and a certain point, I can do the simple stuff really, really well, much better than I could when I first started.
Yeah,
right?
of course.
So it's like, I'm going to be better than it, but you don't really need somebody like me.
Yeah. Oh, this is,
really
again,
simple, right? Like,
I'm always like connecting things. It reminds me of like my neurologist. I always want to go through him for stuff because I'm like, I just know you're really smart and you know stuff and you'll just get stuff done. But they're always like, this is not related to your, like, you got to go through the GP. I'm like, oh, please. It's like, you don't pay me enough. You don't pay me at all.
That's not his area of specialty, right? He could do it.
Oh, yeah.
I'm sure he could do it, but it's not his area of speciality, right?
Yeah.
So it's like, Anyway,
Totally.
so that's what I charge on the first 500,000, and then I charge 0.95 on the next 500,000.
Okay.
Right, and then 0.6 on the next $1 million. So this is now somebody with $2 million. Every penny after that, you're paying 0.6, and the next $3 million, 0.33. So you'll notice it drops off very quickly.
Yeah.
And then next 0.26, and then anything over $10 million, 0.35. So it actually jumps up because that then covers the cost of running the portfolio.
Because there's probably a lot more, maybe.
No, but the 0.35 is my baseline for just managing money.
Okay.
Basically. So the reason it's lower on the next 5 is to make up for the higher
earlier
amounts
times
at the beginning. Yeah. Right.
Man, you're kind of smart.
Put a lot of thought into this, and a lot of thought into exactly what I thought was fair.
Interesting.
And the way that I do it.
But I feel like, again, as a client, like if I were a client, just seeing this, like it's super simple. I'm like, okay, yep, makes sense. I understand. Like
it gets cheaper as the amount goes up. I do not believe nobody can look me straight in the face and say that managing $500,000 is easier or harder than managing $1 million. It's simply not. It's about the complexity of the individual. You can have somebody worth negative $1 million and it'd be a very time intensive to manage their their financial affairs, right? So
Yeah.
that's why it's so much higher on the first part of the money, because I need to cover the basic time it takes me to.
And like you said, it's almost like a coaching thing too. Like, where are they kind of starting? You might need to put a lot of time into their knowledge or something.
Yeah. Anyway, that I would say that is again on the first part of the assets. I would consider myself expensive. If you walk into just a basic, like something like if you walk into a branch or something like that, you should be able to get around paying 1%, if not less. Like you might be able to find, like if you have like $200,000 or $300,000, you might be able to get like somebody at RBC or something like that, like the big banks, to give you like 0.8 or something like that. They might be able to, like with manager approval or something like that, is probably the lowest that you're going to get. If you're working with, so that's if you're working with a person, okay? There's the other side of it that now you're just using, so you're not getting the planning piece, you're just wanting strict investment management, like manage my portfolio, nothing else. Then you're looking at robo-advisors, okay? Robo-advisors, the fees will range, but you're looking at about between 0.2% to 0.56%, right? So then the all-in cost is, because most of the robo-advisors use passive strategies, so the all-in cost, you're sitting at like under 1%, which is, if you're willing to do the administration of running your finances and stuff yourself, then that's a really, really good way to
do it.
Good way to do it. Good way to go. But basically, in the current environment, you're paying for planning.
Yeah, because
you're paying for the planning, you're paying for the coaching. You're not. It doesn't make sense with the information that we have for you to pay somebody significantly more to attempt to beat the market. It's not. You're paying for somebody. If you are paying for a person, you're paying for them to help you navigate the markets, for them to pick the appropriate investment allocation, things like that, which is why I think it is really important that advisors coach your clients to where they should be objectively versus just making them comfortable and let them sit in what they want. Yeah. Because part of your value is, and we have the data, so you can't tell me that we don't have the data, and every client is every client is different to a degree, but not different enough for you to be able to look and not push back when clients want to do one thing, but the evidence points at something else. So if a client comes in and says, hey, I'm 30 years old, I just got $1 million from my grandparents' estate, and I don't need any of the money at all, I don't know what to do with it.
Let's put it in a term.
There are things that you shouldn't be doing with that money, right? There is a right and wrong answer to some of these questions.
Yeah.
That coaching them is really that massive part of it. Anyway, does that make sense? I feel like I covered the items that people wanted. Something else to be said. There are tiers, I would say, of like money management in the industry. So you have like the branch level, which you're talking like the introductory investors group stuff, the like branches like RBC.
Like you're talking about like
if you walk into somewhere and
like can I just say like FA3s? Like basically, but not like their wealth side.
Yeah, but you have to explain what that means now. If you
sorry, I don't know how to.
Like the person that they'll probably do a mortgage for you at the same time as investing your TFSA.
Yeah,
basically.
Like I would say if you have a financial advisor at a bank right now that does your day-to-day financial stuff.
Yeah.
And they haven't referred you elsewhere for this stuff, then that's like the branch level.
Yeah. But I would actually say I'm going to add a level. I'm going to say that would be level 2. Oh. I'd say level 1 is like the part-time insurance licensed people that I'm not even going to get into that in this episode, but like
episode
where
4
they have no real business, in my opinion, giving investment advice because they do the bare minimum amount of schooling and then just try to sling commission-based like insurance products and stuff like that. It's a really big issue. I take a big issue to it because a lot of the people that are victims of that are people with low financial literacy. But I would say that's level one. That's like, if I had it my way, nobody'd ever deal with them type of people again. Yeah. Then you have level 2, which is the bank stuff. And as you go up these levels, you should really expect to pay more if you're a smaller investor, right? So then you have level 2 advisors, which would be like branches and things like that, where they likely have a lot more, significantly more experience than the first tier. Probably most would be trying, I do like to give them the benefit of the doubt, most would try to be doing the right thing, but they often don't have the experience to know whether they're doing the right thing or not. But you could be okay, right? That would be my starting point if I had no idea where to turn and just wanted to get invested. Then you'd have like level 3, which should be like where I sit, where you're likely going to be referred by the branches to the wealth management side, where that's where you have the planners and the lawyers and like all that type of stuff on staff, where you'll be building proper plans. That's where most people would sit. And then you would get to like level 4, which would be like the highest level, which you're talking about family offices, where this individual has $50 million and they pretty much hire their own staff, or they work with a firm that manages 5 households. Yeah. And they have a full suite of staff. They have the lawyer, the account, all of them on staff, and manage 5 households, and that's kind of that level. That's like the highest level.
Yeah.
Right. It's kind of the stages that you really have, but expect to pay appropriately for those levels. And I would say you'd probably want to work up them pretty quick.
From the bottom ones.
Yeah,
at least get to level 3.
Yeah.
Maybe not everyone's getting to level 4.
No. And I would say similar thing is I would do, if I had $50 million, I would do that for sure, but I wouldn't be changing my investment philosophy because I had $50 million. It'd be more a case of I would want a dedicated lawyer that has 5 clients. You're going to get a lot of personalized attention at that level. You probably have a huge amount of complexity in business assets and all that stuff.
And they know you super well.
Yeah, I'd want that dedicated. You're working with just on my stuff for 3 months out of the year. Okay, I'd pay for that, as opposed to somebody even like at my level where you may have 100 households, right?
Yeah,
something like that. So yeah. Anyway, that's it. That's all we're going to cover, I think, for that one.
Perfect.
Anything you wanted to add?
No. Hey. And it makes more sense now than it ever did before, so that's good.
There you go. So to summarize, just because you're paying more doesn't mean that it's worth it.
Yep. Go check what your fees are.
Go check what your fees are. If you have friends and stuff and they are invested at XYZ place, go check. Go make sure. And there's a difference between what you're paying and value, right? So if it is something valuable to you, for example, we have a fund company called NEI, which is like ethical investments. They're very, very good at what they do. They're expensive, but some people, it's really, really important to them that they don't invest in anything that contributes to fossil fuel stuff, right? So if that is something that's really, really important to you, you have to understand you're going to pay for that, which higher fees mean you should expect lower returns, right? And that's a trade-off that you have to, as long as you make that knowing that you're making that trade-off, that's all I want. Right?
For sure.
What I want for everyone is that you make an informed decision, you understand that you're having that trade-off, and you're okay with it.
Sometimes I feel like people think, oh, I'm going to be judged for this decision. It's like, no, maybe. I don't know. I can't speak for anybody else. But I think for the most part, people don't necessarily care as long as you know exactly what you're paying for and like what you're doing. So
exactly. That's all I want for people.
As long as you can argue why you're doing maybe not. Okay. Just ignore me. It's really warm in this room. I'm dying.
It is. Okay, perfect. We'll see you guys in the next one.
Bye.
Bye. Thanks for listening to this episode of the Plain English Finance Podcast. Trey Bino, Certified Financial Planner, Chartered Investment Manager, is a financial planner with TC Wealth Management and Aviso Wealth. You should always consult with your financial, legal, and tax advisors before making changes. This podcast is provided as a general source of information and should not be considered personal investment advice or solicitation to buy or sell any securities. The views expressed are those of the individual and are not necessarily those of Aviso Financial Inc. Mutual funds and other securities are offered through Aviso Wealth, a division of Aviso Financial Inc.
Oh my God. Welcome back to my channel, everyone. I know you've been dying to hear from me, obviously, in the next episode of Cease's podcast about personality types and cognitive function preferences. So, Mom, you want to know more about your cognitive preferences, huh? Do you ever remember what your preferences were? I don't think so. I bet you couldn't even tell me one. After so many times I've told you about your preferences. ESFP, extroverted sensing, introverted feeling, extroverted thinking, introverted intuition. That's your stack from top to bottom. Driver, co-pilot, 10-year-old passenger, 3-year-old passenger. So basically your 10-year-old is when you're like, I want to be efficient, I want to be effective, and you're doing things that don't actually make sense because it's a 10-year-old's way of doing things effectively. That's something you like about yourself. You're like, I'm so good at knowing the route to something. You know how you guys always make fun of me for being bad at directions? It's because I feel like extroverted thinking is really good at that. But you guys do things that don't make sense sometimes. Like not use Google Maps out of stubbornness just because you think somehow you know best. That's just not true. And then we have introverted intuition, which is your 3-year-old function. And that is where you love to catastrophize. Like when Araya is walking on the rug and you say, Araya should be wearing pants that cover her knees because if she trips and falls on the rug, she's going to get rug burn so bad on her knees that they're going to bleed so badly that they're going to get infected. And if they don't get infected, she's going to bleed so much that she's going to bleed out and die. Unreal. Unreal. That's your introverted intuition. Running simulations in your head. But yours is a 3-year-old. And mine is my driver. It's an adult. So I'm going to take it from here. On those, thank you. What else can I say? This is a long pause. Trey's putting Araya to sleep right now. Hopefully she's okay. I just put her down, so it's really bizarre that she's awake right now. That hasn't happened in a long time. Hopefully she's okay. I just know if Mom watches all this story, she's going to be like, Sierra is hilarious. Sierra is so hilarious. And then my ego is going to inflate again because I know I'm the funniest person I know. It's because Mom always told me how funny I was. So I just believed it. And then Trey tells me, you're not funny. And I'm like, well, that's just simply not true. It's obvious. I'm funny. And I just know Mom's going to be sitting there on her laptop, dying laughing watching this. She's probably going to like the little boots and cats beatbox I did at the beginning. She's going to love the reiteration of Araya tripping and falling. She's probably going to laugh really hard at that. Yeah. Unless Trey gets to this first. And he's probably be like, delete. He probably won't even watch this. Maybe no one will see this. Maybe this will never make it to the light of day.